we are now very close to marking all-time highs. We are within 2%, basically about 1.5% really, of all-time highs on the market. So it is very likely by the end of next week, the markets will set all-time highs. And so we're going to basically wipe out all of that decline that we had in 2022 will have been marked out in 2023, and we'll have completely recovered that. Here's what you need to know before the bell. Yesterday's FOMC meeting took the bearish bias off the markets. And again, look, markets are very overbought. We've been talking about this for a while. Markets are extremely overbought here. Everything is kind of pegged in terms of their bullishness, right? So retail investor sentiment is extremely bullish now. 90% of stocks are above their 50-day moving average. Whenever historically you get this overbought, you get a correction, but it doesn't mean it has to happen right away. And that's basically been the case here. And again, we talk about this whole Santa Claus rally issue, what's going on. That is, as you know, despite the fact that we didn't get a correction, something we'd said earlier in the month that we could get a correction or consolidation, that's exactly what happened. We consolidated this market for about 3 weeks coming into December as mutual funds are making their distributions. The Santa Claus rally has now arrived about a week early, but we are off to the races here. And, markets, again, very overbought. No doubt about that. Flipped the buy signal back on yesterday from a very high level. So that's, that doesn't give you a lot of room to work here because you are very extended on the signal. And markets are really overbought on a relative strength basis. So, that hasn't changed. It's just kind of gotten worse over the last day or so. But there are some important kind of technical things that are going on that are certainly much more encouraging for the markets going into 2024. So we need to take a little bit longer look here at the markets and look at what's going on here. So first of all, we are now very close to marking all-time highs. We are within 2%, basically about 1.5% really, of all-time highs on the market. So it is very likely by the end of next week, the markets will set all-time highs. And so we're going to basically wipe out all of that decline that we had in 2022 will have been marked out in 2023, and we'll have completely recovered that. Also from a technical basis, there's what's known as a cup and handle pattern. And this is a very bullish formation for stocks. And generally, when these patterns complete, and we're very close to completing this pattern, you are going to have higher asset prices in the future. So basically, it would augur for a much stronger market next year than many people are expecting. But you had this very nice cup handle, kind of the cup formation building. So we had this previous market top. We created this cup in the markets, which is this decline that was in 2022, this rally that started in October. You then had this correction in July, in August, September, October of this year that then created this handle pattern that we are now in the process of completing the breakout of that handle pattern. So this all suggests that markets are very much back into a bullish mode for now. And again, look, things can change, and this is why it's important to always manage risk, manage your outlooks, those type of things. Right now, this is a very bullish pattern. Now, that does not preclude the fact that we can have another 3 to 5% correction at all. But again, going back and looking at markets from being this overbought, this extended, this deviated from moving averages, etc., you are going to have a 3 to 5% correction at some point. Now, when that occurs, it could happen tomorrow, could happen Monday, could happen next week. I don't know when it'll occur. It will occur. But that is going to be a buying opportunity, not a selling opportunity. And so when markets get back to working off some of these overbought conditions, and they will. And again, all you have to do is look at the markets over time, right? So people get this idea that markets are just going to go higher from here. Nothing's going to stop this train. It's all up from here. Markets don't work that way. I mean, all you have to do is look at a chart and see that prices move up and down over time. So, it's important not to fall into that trap of being pushed into making investments, buying things that are really overbought. You'll have an opportunity, be patient, and you'll get a better point to add exposure to your portfolio. Very quickly, let me switch over to bonds because that's the other big topic right now, something that Mike and I will also get into today as well. Yesterday, so this is a chart of the treasury yields, right? So this is interest rates, not the prices of bonds, which is why it's going down, not up. Bond prices going up, treasury yields going down. One thing that we've been talking about for a while is that as we start getting through this process, yields are going to fall as inflation comes down, economic growth is slowing, we are seeing slower rates of economic growth. That's going to pull these yields down. Mike and I have been writing that yields were improperly priced for where we were economically. The yields were way too high relative to economic growth, and that was going to revert. We are now going through that. We are going to take out the 200-day moving average today on 10-year treasury yields. That, just like the market, is going to augur for higher bond prices, lower yields. Now, again, there's been a very big move here. We're probably going to see some point here where yields back up a little bit. But just like the stock market, when yields correct or stocks correct, and they'll likely happen together for whatever news drives that, that's going to be your opportunity to add bond exposures to your portfolio, etc. But again, yields very overbought here, just like stocks are very overbought. So you're going to get a little bit of a correction here at some point, give you a better opportunity to shift duration in your portfolio, something that we'll do as well. But yields are now very back into a bullish trend. So if you didn't lock in those 5% yields when we were talking about it, that opportunity, probably gone. So that's what you need to know before the bell this morning.